First, the ECB has embarked a QE infinite. The ECB follows the same strategy as the Fed with just 2 or 3 year delay. The clear risk for the ECB is that headline inflation could remain below 1%, meaning the ECB will be obliged to increase and increase again its QE. The solution could be that the ECB may finally announce in December an open-ended QE. Second, the euro is too high. The 2% target inflation could be achieved via a sharp depreciation of the euro or a strong rebound in commodity prices, but this is not our core scenario. Mr. Draghi has recognized the huge impact of the euro on inflation, and its current level versus the USD and other emerging currency is too high. Of course, part of the job of depreciating the currency could be made by the Fed if ever the US Central Bank will decide in December to raise its key rate. But if the Fed does not change its rate, the ECB will be obliged to lower the deposit rate from minus 0.20% to minus 0.30% or more. This is the only case in which managing negative deposit rates could be useful to lower the exchange rate. Third point, liquidity is a major concern. There is a lot of liquidity in the economy and in the financial markets, but as a paradox, there is not enough liquidity in specific segments, such as government bonds and corporate credit. If the ECB decides to increase the amount of its QE, let's imagine from 60 billion euro per month to 70 or 80 billion, the liquidity problem will increase while nominal interest rates will decrease, but the risk premium will not decrease. Thus, the ECB could be obliged to buy risky assets such as corporate credit or stocks. Decreasing nominal rates further will not improve the transmission channel to risky assets and the real economy. Fourth point, last but not least, the limit of the monetary policy has probably been reached. Liquidity injections and the related increase in the balance sheet of the central bank had very positive effects on asset prices. In parallel with LTRO measures, the credit has also been boosted. Nevertheless, it is not sure the ECB is creating new demand. Let's conclude. The ECB has embarked a QE infinite. The euro is too high, obliging the bank to lower the deposit rate, but liquidity and final demand could even, in this case, remain low. A better mix in the economic policy will be required. The risk of a QE infinite is to create bubbles in markets well in advance before creating an inflation pressure in the real economy.